Hi, I'm Justin, and welcome to the Landis Look, where we take an inside look at the world of real estate. Mark Dacre, a friend of the Landis Look, who has, if any of you all have been watching, has become a little bit of a regular here over the last couple months, is here today to talk with us about accessing our equity in our home. So, Mark, appreciate you being here.
Yeah, my pleasure.
And an introduction for those of you who haven't seen Mark before. Mark is with the Ameris Bank. He's a mortgage lender. He's actually the #1 mortgage lender in the whole state of Georgia. And so he is a wealth of knowledge. And today we're going to talk, like I said, about accessing equity in your home. Now, we're fortunate here in Atlanta that a lot of people who bought their houses 2011, 12, 13, 14, even 2016, 17 have a good amount of equity in their house. Yeah. And then there's also people that have their house for a long time, paid it down, or maybe paid it all off. And so here we're going to see what options do they have if they want to access that equity, and what are some of the pros and cons of that. So there's a couple main ways that if you want to access equity in your house, you can do it. What are those probably the most common ways?
Sure. Yeah, the two most popular ways, probably the most popular way, is to just do a basic home equity line of credit. And all that means is that someone is going to give you a line of credit that you can draw on, no questions asked, use it as you want, against the equity that you have in your home. The benefits of that are it's very flexible. So it literally functions just like a credit card, with the exception that the debt is securitized against your home. So as you pay on it, or as you draw on it, you will pay interest on it. If you don't draw on it, you don't pay any interest on it. If you don't use it, it just sits there. It's just like a credit card.
What kind of interest rates and closing costs? I mean, is this an expensive loan to get?
It's a cheap and easy loan to get. So it's cheaper and easier for the most part than doing a traditional mortgage. The closing costs usually aren't much more than getting an appraisal and maybe some small attorney's fees. The interest rates, the drawback to it is the interest rates are generally adjustable. So the Fed controls the prime rate, and home equity lines are generally tied to the prime rate. So if that prime rate goes up or down, recently it's been going down, but if it were to go back up, your home equity line could go up indefinitely.
So this would be something where, hey, you know that you're using this money for something that's going to take a long time to pay back, or it's something long term. If you have that, you do have that risk that interest rates could be a lot different 5 or 6 years from now if you have not paid that loan back. Is that one of the biggest risks of this?
Yeah, that's probably the biggest risk. If that loan is still going to be sitting out there years from now, you're going to use all of it. Just like a credit card, in general, credit card rates can go up or down. If that rate goes up, you're going to be subject to whatever that increase is, so you cannot count on that payment over the long term.
Okay. And what sort of loan to value can people do on this? So say that your house appraises for $500,000, you owe $200,000, so you have $300,000 in equity. Yeah. Does it work on a percentage basis? Is that how it works?
It does. In general, you can find home equity lines up to 90% of your home's value. So in that case, it'd be $450,000 minus, I think you said $200,000 in current debt. So in that case, you'd have a lot of equity to tap into.
A lot of equity.
$250,000 on an open line of credit that you could use any way you want.
So what do people do with these? They go to Vegas and play the slots and try to turn this into $500,000? I mean, seriously, what is some of the most common reasons that people look for these loans?
Certainly the most common reason is to do some sort of home improvements. Okay. And often that's justifiable because they will do the home improvements and then maybe look at coming back and consolidating their home equity line and their current mortgage into a new single refinanced loan that is then all a single fixed rate later.
And so that's a perfect segue, because the other main way to access equity is to do what's called a cash out refi, right? Cash out refinance.
Yeah.
So tell us a little bit about that.
Yeah. So that is just doing a completely new mortgage. We are going to, let's use our same example. Let's say we're going to go up to 80%. Usually that's the cap on cash out refinances. So you have a $500,000 valuation on your home. You can go up to 80% total. So that means you can get $400,000 in total debt. If you have $200,000 in current debt on that home, that means we're going to give you a new loan for $400,000. We're going to pay off your current $200,000 loan, and we're going to give you at closing a check for $200,000. It's not a line of credit. So you just have that money. It's not like a functional thing like a credit card where you can charge up your card 1 month, pay it down the next. This is just your new loan balance. Now, of course, like any mortgage, you can always pay it down if you want to, but then you don't have access to it again. Yes. So it's a structured financial instrument at that point.
And so then you've got that $400,000 loan. And so pros on that, I assume, are one, if you've done it for a fixed rate, you've taken that risk off your plate that the rate switches, right? But then you also now have a new loan payment that is based on the $400,000, right?
Correct. It's not a functional loan that is used as you use the money. You just now have a $400,000 loan and you have $200,000 in your account to do whatever you're planning to do with it.
So sometimes people will ask us this when they are potentially either going to sell their house and buy something else, or they're thinking about maybe getting another property. Are there any sort of rules that play around that from a timing standpoint, that if you're doing something with an existing property that you may either sell or you want to buy another one, that you have to be careful to access that equity, that it might impact a future loan?
Yeah. So in general, if you're going to access that equity, either to apply against a future loan for a future home purchase or just period, normally you can't have your home on the market in order to pull the equity out of your home for a lot of loan options. So certainly it's a great option as well, though, especially they're referred to as bridge loans, these home equity loans. If you wanted to try and tap into some of the equity of your home, especially if we have a situation like the one we've described where you could access $250,000 of equity, you could then apply that towards the down payment of your next house without having actually sold your house.
Yeah.
So.
Okay. Yeah, that makes a lot of sense. And so as we look at this, you have the access to this, but I mean, just one thing I want to say, probably shouldn't use this as like a credit card for your life though, right? I mean, a lot of people, I feel like, got into trouble doing that before the crash last time, that just because this money is available doesn't always mean that it's the right thing to do, right?
Yeah, absolutely. I mean, it would be in some ways, but in different ways, synonymous to tapping into your 401k and getting a 401k loan to go buy boats, cars, whatever. There was, and years ago, prior to the real estate crash, because home values were just shooting up so fast, people were getting home equity lines left and right. And there is a case to be made to use those to make other purchases, assuming those were purchases you were absolutely going to make otherwise, that you were going to put some form of debt on. But if it just starts giving you access to a whole world of things you weren't going to buy otherwise, that's where you could certainly get in some trouble.
Yeah, cool. So if you have equity in your house and you're thinking about doing a project or have a reason for it, Mark will be happy to help you think through which option is best for you. Another thing that we do for a lot of folks that we'd be happy to do for you as well is we mentioned the value of your home, in that example being $500,000. And while we can't do an actual appraisal that Mark can do to do a loan, a lot of times people will say, hey, Justin, what do you think my house is worth? Or give me an idea, of what you think the appraisal might be, so we can figure out, hey, is it worth our time to do this? Because then you can say, hey, if we think it's worth 400 or if it's worth 500, might be a big difference in whether you even want to go down the process, pay for an appraisal, consider making those plans in your house. We're happy to do that for you as well. You can drop us a comment here and we'll follow up with you, or you can send us a private message and we'll get back with you on that to get all your questions answered. So Mark, thanks again for being here. Yeah. We always appreciate you. Yeah. And everyone, we'll see you next week.